class, I'm going to use the term security, but I'm also going to probably say Facebook or Apple. I might say Google. I might say Bitcoin. I might say the euro US dollar. I might say, gold. I might say oil. I'm not referring to any specific asset. It just gets very, very boring saying security, security, security over and over again. So, whether I'm talking about Facebook or whether I'm talking about the euro, I'm talking about any publicly traded financial instrument that has an open market. Also, I'm going to intermix the terms investing and trading. Now, we know the difference. An investor takes a much longer term position, while a trader takes a short-term position and is more concerned with short-term movements. In either case, the basic concepts and techniques are equally adept, but I intermix the terms trading and investing. I know the difference, you know the difference. It just gets very, very boring saying trading, trading, trading. Now, all of us are always asking this one question, and think if I were to go back to all the emails I've gotten in all the years I've been teaching, the biggest question I always get is, should I buy or should I sell? That is followed up as, well, what will the price be later today? What will the price be tomorrow? What will the price be next week? What will the price be an hour from now? Well, wouldn't investing or trading be easy if we knew the answers to these seemingly simple questions? But I don't have a crystal ball, and I don't have a Ouija board, and I don't think any of you do. And anybody out there that's professing that they can give you a system, a strategy, an indicator, scanner that'll tell you where an asset is going, what it's going to do, where it will be, is full of BS. You can increase your technical analysis, and any analysis is used for filters. They're filtering out to only leave you high probability successful trades. There's nothing that's going to tell you where the euro should be at 4 o'clock this afternoon, or where it's going to be at 5:30 this afternoon. And if you think the euro is at 113 now, and you think in 2 hours from now it's going to be at 113.5, well, good luck to you, because there's no guarantee it's going to be at 113.5 at 2 hours from now. Now, it may be at 113.5 at the end of the day, or it might be up there to tomorrow morning. But there's nothing that's going to tell you when it's going to be, where it's going to be, because there's too many factors that affect the market. So if you're attending tonight's class in the hopes that technical analysis, especially using MACD, is going to tell you what to buy, what to sell, and it's going to tell you make you rich overnight, But if you're attending tonight's webinar with the hope that technical analysis will improve your investing, I've got good news for you. It surely will do that. And remember, if you're a successful, or all successful investors and traders, rely more on their risk management component than they do their trade decision component. Because your trading decision component, which is this combination of setting your stop losses, your exit points, your entry points, and deciding whether you're going to buy or sell, are nowhere near as important as your risk management strategy and your exit strategy. Because the entire philosophy, the entire thing that we do investing or trading is to minimize our risk at all times. If you keep your risk low, your trades that make profit will offset your losses, and you will come out a winner, and you won't have your account wiped out. So what we're looking for is, besides having a great risk management strategy, are indicators or weapons that will help us filter down and throw out all the trades. Because there's so many assets out there. They're all moving around all day. There's a billion trading opportunities all day, every day. All we want to do is have some way to filter all those crazy trades away and keep filtering down till we're only left with trades that have high probability success rates. This will help us ensure that with our proper risk management, that when we make a trade and it is successful, it will rally more than enough or go in the direction we want more than enough to cover our previous losses. Now, MACD, or Moving Average Convergence and Divergence, is one of the best tools you can have in your arsenal because it helps us in many ways. And it's one of the most reliable indicators in the marketplace. It was originally developed by Gerald Arpel in the late 1970s. So that puts it at about 50 years old. So it's been around a very long time. Now, 50 years ago, what were we trading? Well, we had a much slower environment. We didn't really have, well, we had no PCs. We didn't have internet. Most everything was being done by hand. We were hand charting. And most everybody was trading, or most people that were trading stocks. And then you had a couple that were trading commodities and futures. But in a very slow environment. When I was trading 50 years ago, I mean, we would go to a broker's office, sit in the pit in his office and use his ticker tape because that's how we were getting prices. And prices would come through very slowly and we would be hand charting. It wasn't like today where we have this internet and these online platforms with numbers coming at us in a flash of a second. But MACD was a great indicator then. But it's withstood the test of time. It's withstood the change in the entire industry. It's withstood going from slow-moving markets to fast-moving markets. In those days, there was no such thing as forex. Central banks were the only ones that exchanged, currency. We didn't have the euro. We were still dealing with the franc and, the Deutschmark and all these other things. But MACD has managed to become and stay one of the most popular and broadly used indicators in the marketplace. Now, the letters MACD stand for Moving Average Convergence and Divergence. It is typically known as what is a lagging indicator. Okay. Now, don't think that the term lagging is not derogatory. In the world of finance, we have leading and lagging indicators. They're not like you're leading in school or lagging behind in school, which are negative and positive. Leading indicators precede the market. Lagging indicators confirm a market move. Now, the basic function of the MACD indicator is to discover new trends and to help identify the end of the current trend. There are various ways to gauge the signals or the alerts generated by MACD, and many traders use their own unique settings and methods around this trading indicator. Now, before we can go on and learn about MACD, you've got to learn how it's put on a chart, what all the lines do, what the mathematical formulas are. You'll never have to do any calculation, but you have to understand how all this is put together in this indicator so that you can see and find when there are problems, when the market isn't aligning right, when it's giving you false signals. Now, the MACD indicator is typically placed at the bottom of the trading chart in a separate window beneath the price chart. Now, MACD is a relatively easy tool to use. However, it's crucial to understand it fully before attempting to trade using its signals. Now, the concept behind MACD is fairly straightforward. And I'm going to apologize to you now because this gets a wee bit boring, and I've tried and I will try to make it not boring for you. But MACD uses so many indicators. MACD is an indicator of an indicator of an indicator of an indicator. Okay, and that sounds like a lot. But again, there's nothing you'll ever have to calculate. But you have to know what the calculations are and what it relies on. So essentially, it calculates the difference between an instrument's 26-day and 12-day exponential moving average. Okay. So let's go over to a live chart and let's see if we can make this a little bit more interesting. So here we have the euro US dollar. It's the current live chart. So MACD starts out by using a 12 period and a 26 period EMA. Now, an exponential moving average is different than a simple moving average. An exponential moving average is a more complex formula that gives more weight to the most current price movements and a little bit less weight to the older price movements. So it's a little bit more reliable, and by using the EMA as opposed to an SMA, you move a lot of the lag time away. So it's more current, it reacts faster. So the first thing we do is we put on our chart a 12-period EMA. So we have that on this chart in gold. We then add a 26-period EMA. And we have that on this chart in blue. Now, for those of you who are not too knowledgeable on moving averages, a shorter period moving average is considered a faster moving average. So whenever you have two moving averages of varying lengths, the shorter the period, the faster it responds to price movement. So it's referred to as the slower moving average, the faster moving average, and the one with the longer period is referred to as the slower moving average. So in this case, the 12-period moving average is the faster of the two. It reacts faster. So it's known as the faster moving average, and the 26-period is the slower because it's using 26 periods, so it reacts slower to current market changes. But whenever you use moving averages and you're using two moving averages, one's a slower and one's a faster. But if you're simply using these two moving averages on a price chart, you're not using MACD. You're using what's called a moving average crossover strategy. It's a very simplistic indicator, works quite well. And what it does, it bases its signals or its alerts when the 12-period or the slower crosses the faster moving average. And at each crossover, you either get a buy or a sell signal depending on which line is rising and which one is falling. Well, this is only the first part of MACD. This is the first derivative used in calculating MACD. So we start out with these two lines or these two numbers. We then subtract one number from the other or one line from the other. We subtract we take the faster moving average and subtract from it the slower moving average. Now, when they cross over each other, what would the difference be? The difference would always be zero because you're subtracting two identical numbers from each other. So to make it a little bit easier, we plot these two lines, the difference between these two lines on the bottom of our chart, and we use a zero as the central basic line because every time these two numbers touch, they're at zero. Now they can separate as broadly as they want. They can actually be 22 points apart or 10, 5 points apart or 1,000,000 points apart. Doesn't make a difference. Only when they cross over each other are they zero. So we start out with a zero line. And what we do is we subtract the gold line from the blue line. And this is known as the MACD line. And it is plotted on the bottom of our chart underneath price. And that is the first derivative. It's the difference between the two moving averages above. So at this point, we no longer need these moving averages because all we actually did was needed the calculation to do the subtraction. So once again, every time this blue line down below crosses a zero line, so were the two moving averages above crossing each other. When it crosses over the zero line, the gold moving average, or the faster moving average, was getting much bigger than the slower moving average. When it crosses zero going down below, the longer moving average, the 26 period, was getting bigger than the shorter period. Okay. So when You subtract a bigger number from a smaller number, you get a negative, or you get something below 0. So that's our first step. So now we have our blue line, which is referred to as the MACD line. Now, okay, this doesn't tell us much of anything. Again, even if we were to use this one blue line, we would be trading a moving average crossover strategy. So Gerald Arpel took it the next step farther. He then would take a 9-period moving average of the blue line and take the 9-period moving average of this blue line, and this would become what's called the signal or the trigger line. So when the signal line, this plotted down below, crosses over the MACD line, the blue line, it gives us a buy signal. When it crosses over and comes down below, it gives us a sell signal. So whenever they cross, they are giving us some alert to do something. Now, the thing about MACD is that MACD does not, in any case, tell you the momentum or how far the asset will move. It's only giving you buy and sell alerts. You have to apply other pieces of information because the MACD line is saying buy, but it's not telling you how long it's going to go up or how far it's going to go up. So unless you do some other types of interpretation, you could get in a buy scenario that just goes up 5 pips and falls right back down. Okay, so you didn't even cover the spread. So it can give you a lot of false signals because it's not telling you anything about momentum or how far it's going to move. So this is why you would use MACD in conjunction with other indicators, because MACD simply gives you alert. It's smacking you on the back of the head and saying, hey, there's an opportunity here to buy or an opportunity here to go long. Well, we do need a little bit more information than just this. So it works extremely well with support and resistance lines. It works extremely well with volume. It works extremely well with chart patterns. But we're not done with MACD yet, because MACD will eventually give us 3 complete stories. It will give us overbought and oversold indicators. It will give us reversal indicators, and it will actually give us buy and sell alerts. So we're only at a derivative of a derivative of a derivative right now. We have to go to the next step. And what MACD does, remember the 0 line. What MACD now does, or what the indicator does, or the next step, is you would take the blue line here, the MACD line, and subtract the signal line from it. Because again, whenever they cross, they give you buy or sell signals, but the crossover, the difference from the crossover would always be at the 0. Not on the 0 line like these were, because this 0 line is applying to the moving averages above and below. But whenever the MACD line crosses its trigger line or its signal line, it too, the difference would be 0. So that would have to be plotted differently. So to do that, we then apply and use what's called a histogram. So some people might call it a bar chart, a bar graph. Okay. So what we have now is the histogram. This histogram is the difference of the MACD line and the trigger line. And if you notice, the histogram reflects pretty accurately price movement up above, even though it's not calculated on price. And whenever the MACD lines cross each other, where's the histogram? It's at 0. when the signal line crosses above the MACD line, which would be a sell alert, you would see it coming down because it would be a minus number. And when it crosses over and goes up, that the MACD line is larger than the signal line, it would go over up in green. Now, you can use green and red. You can use just black if you want. But up into positive numbers is telling you the MACD line is larger than a signal line. And down into negative numbers is telling you the trigger line or the signal line is larger than the MACD line. At 0, it's the crossover again. Now, we can also see the depth of the movement or the steepness of the movement in the slope of the histogram. So the histogram is telling you how price is moving currently, and the steeper the histogram, when you see a very steep peak or valley, mountain or valley, that's telling you the asset is most likely getting overbought or oversold. So this is how we put MACD on our chart. Now, a lot of people, including myself, do not use the signal line and the crossover line, because at this point, we could actually remove the MACD line and the signal line and simply trade from the histogram. Okay. That takes a little bit of time and experience because we like to see the signal line and trigger line. I trade only from this MACD histogram. Now, there are many ways you can use this histogram. We can see divergence. Divergence is when the histogram is moving in one direction while price is moving in the opposite direction. We can see overbought and oversold indicators. In other words, when the histogram is soared way too high or way too low, it's telling you the market is overbought or oversold. Plus at the 0 line, we're getting our buy and sell alerts. And this is how we put MACD on our charts. Okay. Now, hopefully that wasn't all that boring. So now that we have it on our charts, okay, we have to learn how to start using it. Now remember, the MACD histogram is just an elegant visual representation of the difference between the MACD and its 9-day EMA. The histogram is positive when the MACD line is above its 9-day EMA and negative when the MACD line is below its EMA. If prices are rising, the histogram grows larger as the speed of the price movement accelerates and contracts as the price movement decelerates. The same principle works in reverse as prices are falling. In other words, the peaks and the valleys. So the moving average convergence and divergence is both a momentum oscillator and a price-based oscillator, and is one of the most reliable studies that we have. While it is a lagging indicator, it works well in all time frames. Now that's something you have to remember, because a lot of indicators don't work well in very short-term time frames. And since we're mostly all here as CFD traders, we're not actually day traders, because a day trader's trading lots of trades in short windows to make few pips. As a CFD trader, we're more looking to make less trades and make more profit on those trades. Okay. And because the CFD can be kept open overnight to the next day, we're not really day traders. But most of us, 90% of all trades are closed within the same day. Okay, now, a lot of indicators you think you can use, but they really don't work so well in very short time frames. And when you're using a 15-minute chart, a 10-minute chart, a 5-minute chart, because you're making very short-term decisions, some indicators don't work so well. MACD adjusts very quickly and will help you in all time frames. It's a highly interpretive probability signal that is based on the differences existing between 3 moving averages and its histogram. While it is slower than momentum indicators such as stochastics and a relative strength index, if you're willing to sacrifice a little bit of speed in exchange for safety, it's good at keeping you on the right side of the market at all times. So we've gone through all of the interpretation of all the different lines that put us together to make the MACD. Now, MACD gives us, like I said, 3 stories. It gives us crossovers, overbought and oversold conditions, and divergence. So one of the most popular ways that MACD is used is as a buy or sell alert. I'm not going to say signal, and I'm not going to say to buy or sell. Let's call it as an alert. Like I said, it's tapping you on the back of the head and telling you there's an opportunity to buy or sell. So let me share a quick presentation with you that'll show you this more aptly than just seeing screenshots here. And then we'll come back and talk about adding this into your trading strategies. Now, you might have to turn up your volume a little. Sometimes these presentations are not loud enough. I think I got the volume up on this one enough that you can hear it without adjusting your speakers, but you might have to turn up your volume a little bit.
How fast the indicator is going to react to price change. Most of us will probably be chopped to pieces if we rely on only a short-term trading indicator as the basis for any trading system. The MACD line is faster than the signal line, and it's the result of the difference between the fast and the slow moving average. Many traders will use the line as a proxy for momentum. But to make it simpler, think of it as measuring the rate of change of price. The signal line in the MACD is slower due to its setting, and traders will often use that as a trend determination tool, either using multiple time frames or just one trading chart. And knowing that we measure trend and momentum, you may already see how we can use the MACD to actually trade with when we use both the MACD line and the signal line to alert us to possible changes in the market. The 2-line cross can be a powerful indicator of trading potential in the market. Here we've set up the indicator on our chart, and we're going to use the standard settings as we talked about earlier, and we're going to read the MACD. When we want to determine trend direction via the MACD, we can look at where the MACD line is in relation to the signal line. If the MACD line is below, in between the red lines on the chart, we're looking for a short trade. If we see the MACD line is above the signal line, between the green line, this is going to indicate a market in an uptrend, and you'd be bullish on any trading setup. And as mentioned, we're really looking at the rate of change of price. So even though the lines are crossed, price may be compressing. This is one reason that multiple time frame trading is suitable for this trading indicator. You simply look to short rallies during a MACD downtrend and buy pullbacks during an uptrend. And some traders will use the MACD signal line crossovers to buy or sell the market. You may want to consider other variables such as price structure, multiple time frame considerations, and price action in conjunction with trading a simple cross. Once the MACD line crosses over the signal line to the downside, that would be bearish, and you could use that as a signal. Conversely, if the MACD line crosses to the upside, you'd be bullish, and you can use that as a buy signal. And we talked about the fast line being a proxy for momentum, and there may be times where you'll not want to wait for a complete crossover of the MACD to take a trade. So I want to draw your attention to the black round circle at the top of the chart. Here's a pin bar, and it formed after a run-up in price. Also notice the separation in the MACD indicator as price approaches the region, in the same region of previous resistance that's not really seen on this chart. And it shows decent momentum in this market. We see the separation decreasing as price slows down and then explodes to the upside, but closes on its open as seen on the pin bar. This is bearish. Now bring your eyes to the fast line of the MACD, and you can see it hooked to the downside. Given the context of price action and structure, you could gain an early entry into a possible reversal. Depending on the context of the chart, you can use the fast line hook as a buy signal or a sell signal. These can be used to enter the market or as a profit-taking indicator, but doesn't matter. Well, this is a weekly chart, and you would have entered 5 or 6 bars earlier, and you've been up over 120 pips before that breakdown happened. What about divergence? I'm not going to talk about divergence, simply because this all takes into account price action and structure, and I find the normal teachings about divergence has way too many holes, because if you trade just the indicator, you're setting yourself up for a failure. Another way that we can use this indicator is to take advantage of the zero line and the fast line as a means of trade entry. Again, keep in mind the lagging nature of all indicators with this trading method and highly consider using multiple time frames for your trading. You can see the change in trend when during the moving average crossover, so we know we're looking for a short trade. Once the fast line crosses the zero line, this could be a trade entry. You can see how mechanical this is, but it also gets you in very late in the move. You can see on the inset on this graphic that this is the daily chart, and the red line indicates where, after the weekly trend turns down, you would enter on the daily chart using the zero line cross. That black line is where you'd enter on the weekly chart 2 months later. So in summary, with the MACD, we do have a useful technical analysis tool. It has quite a few uses, and we talked about how to determine the trend using the 2-line cross, how to read momentum using the fast line, trade entry using a fast line hook, trade entry using a zero line cross, the benefits of multiple time frame analysis. And as with all technical indicators, you want to test this as part of an overall trading plan. Also, be aware of the lag time using this indicator, although for some traders, it'll be an advantage as you're not picking tops and the bottoms. You may also want to experiment, as with any moving average.
So, as you saw, MACD has some interesting ways that it can be used. Now, MACD is useful as an overbought, oversold indicator. When the shorter moving average pulls away dramatically from the longer moving average, in other words, the MACD rises, it is likely that the symbol or the security of the asset you're looking at is overextending. It will soon return to more realistic levels. Now, divergence, and I mentioned in the presentation that we're not really going to talk about it a lot. Divergence doesn't actually help you make a trade. What divergence does, it alerts you, or it compounds or increases the magnitude of the signal. Divergence is simply explained as when the symbol or the asset is trading in one direction while the signal line is moving in the opposite direction. So they're diverging from one another. So like you see right here on the chart, price is falling. And the definition of a downtrend is lower lows and lower highs. When we look at our MACD line on our chart below, we're seeing the MACD line is actually making higher lows. So it is moving in the opposite direction of the price chart. But this doesn't really tell us to do anything. It just tells us, or tells us that this trend has got a problem. That's it, because we don't know when the divergence can end. It's not telling you anything except it's saying we see a problem in the market. So when we have divergence, but then when we get the signal line crossover, just like we would get with any of the crosses, or it breaks the zero line, that's magnifying the value of that trade or that break. Because it's something was warning you. It's like, you know what, you're driving your car and the little warning light comes on the dashboard. It doesn't tell you what's wrong. It doesn't tell you how long it's going to be before the car breaks down. It doesn't tell you what's going to happen, but it tells you go to the shop. So this is exactly it. It's the warning light telling you to go to the shop. So when the shop tells you, okay, you got a problem with the tire, you know that you really have a problem with the tire because the alert light was there alerting you. So we have in all divergence occurs with all bounded oscillators. Those are oscillators that are bound between price movement. And these oscillators all have divergence. You have bearish divergence and bullish divergence, one going up, one coming down. And then you have hidden divergence, which is a little bit more difficult to explain. But you have to learn about divergence, because the divergence isn't a MACD thing, it's a whole thing about divergence. And we have a whole class actually on divergence. But when we see the indicator moving in opposite or contrary to price, we know we have a problem. So again, like I mentioned, we have bearish and bullish divergence. But again, here, we see here, we've got the divergence. When we get the crossover, okay, it's giving us a lot more information because we're trying, remember, we're always trying to filter down our trades. So it's telling us now that we have a much better or more probable entry point or a direction to trade. When you combine that with support and resistance lines, you have the beginnings of a trading strategy using MACD and a good decision-making capability. So remember, MACD histogram is an indicator of an indicator. In fact, MACD is an indicator of an indicator, and that means that the MACD histogram is 4 steps removed from the price of the underlying security. In other words, it is the 4th derivative of price. So we start out with the 12-period EMA and the 26-period EMA. We then subtract those from each other and end up with the MACD line. Then we take the 9-period EMA of the MACD to come up with the MACD signal line. And then we subtract the MACD line from the signal line to come up with the histogram. So the base of the indicator is the security's price. So all of it's based on price. Every indicator is, because you only have the open, the high, the low, the close, and volume. These are the only numbers you ever have to input into an indicator. You have all kinds of formulas that mash them together, but these are the only piece of information you have. So it is designed to anticipate, the MACD histogram is designed to anticipate signals in MACD, which in turn is designed to identify changes in the price momentum of the underlying security. So one of the most common uses, and we keep talking about it, are transaction signals. Okay. So the transaction signals are the buy and sell alerts, or the smack on the back of your head. Okay. It is what MACD is known for. But remember, you can get easily whiplashed in and out of the markets, because the biggest disadvantage of using this indicator to generate transaction signals is that a trader can get whipsawed in and out of a position several times before being able to capture a strong move or a strong change in momentum. So traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets, because relatively small movements can cause the indicator to change directions quickly. The large number of false signals can result in a trader taking many losses. When commissions or spreads are factored in the equation, the strategy could become expensive. Now, I'm going to share with you a little presentation that's going to show you the most popular indicators and then combine them together in a strategy using MACD that you can add into your trading. And it's going to show you the confluence between several of the most popular indicators and how to use this, how to build the strategy.
Indicator 1, RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2, MACD. The Moving Average Convergence Divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages, which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving close together, and divergence simply means they are moving away from one another. When the shorter term moving average is above the longer term moving average, this area of the indicator will show activity. When the shorter term moving average is below the longer term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market, and may use it as a signal to exit a trade. Indicator 3. Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of their time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4. Super Trend Indicator. The Super Trend Indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5. Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. You can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the Super Trend Indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the Super Trend Indicator to change red here before taking the short trade. So now we have the confluence of 4 indications.
So there we see using MACD with other indicators to make trading decisions that will help us stay on the right side of the market and pick high probability success trades. Because if there was ever a quest in the world for investing, on par with the search of the Holy Grail, it would be acquiring the ability to spot trend changes. There are many ways investors attempt to do this with varying degrees of success. But the common trend tracking tool is the 2-line moving average convergence and divergence. This tool measures an asset's momentum and can aid investors in spotting changes in market sentiment. Momentum in charting is similar to momentum in physics. If you throw a ball in the air, it will ascend at a slower and slower pace the higher it projects. After monitoring the changing momentum, a person can determine when that ball will stop climbing and change direction and descend. So just like in physics, momentum changes occur before the price of an asset changes. So MACD can help us spot these changes. So like life, trading is barely black and white. In the case of the MACD histogram, trading the indicator instead of price offers a new way to trade an old idea. And applying the method to the forex market, which allows effortless scaling of positions, makes this idea even more intriguing to day traders and position traders alike. So thank you very much for joining us tonight. I hope you learned a little bit about MACD. In the handout I gave you, the MACD indicator guide, it goes over all of this with step-by-step instructions with the graphs and the charts and everything I've put together for you. And then the ebook from investing.com on technical indicators goes over what you saw in that last presentation, all the different indicators and combining them together into a successful trading strategy. So thank you very much for joining us. And if you want more information, or you have any questions, just go to www.alvexo.com and contact them, and either go to their education center or contact customer support, and they'll be glad to answer your questions. Thank you very much and have a great trading week. Good night now.